Three oil tankers are burning in the Persian Gulf. Insurance companies are pulling ships out. Crude oil jumps $25 in a week. And somewhere thousands of kilometers away, a middle-class family in India suddenly pays 120 rupees more to fill their bike. That is the strange math of a US-Iran war. Two countries fight, but the economic shockwave travels through oil routes, shipping insurance, currencies, and trade systems, until it quietly lands in India's inflation rate. And the uncomfortable truth is this: India might not fire a single bullet, but its economy could still take the hit. So the real question isn't just, what happens if the US and Iran go to war? The real question is, what happens to India when the world's most dangerous oil corridor explodes? Let's start with geography, because in global economics, maps are destiny. Look at the Strait of Hormuz. It's a tiny water passage between Iran and Oman. At its narrowest point, just 33 kilometers wide. And yet, nearly 20% of the world's oil passes through this one choke point every single day. Saudi oil, UAE oil, Kuwait oil, Iraq oil, all of it flows through this narrow corridor before reaching the rest of the world. And India? India imports about 85% of the oil it consumes. A huge portion of that oil comes from the Middle East. Which means when tension rises near Iran, India's energy supply sits directly in the blast radius. Not militarily, economically. Now, imagine the first week of a real war. Missiles hit oil facilities. Shipping companies panic. Insurance premiums skyrocket. Some tankers refuse to enter the Gulf entirely. Suddenly, global oil supply tightens, and oil markets are extremely sensitive to fear. Even rumors can move prices. During the 2019 Saudi Aramco drone attack, oil jumped nearly 20% in a single day. That was one attack. A full-scale US-Iran conflict could push oil prices well above $120, maybe $150 per barrel. Now here's where the math starts hurting India. Because every $10 increase in crude oil adds enormous pressure on the economy. Higher oil means petrol becomes expensive, diesel becomes expensive, transportation becomes expensive, and once transportation costs rise, everything else follows. Food prices climb, delivery costs climb, electricity costs rise, air tickets spike, inflation spreads quietly through the entire system. It's like a hidden tax, triggered by a war India didn't even start. But oil prices are only the first shockwave. The second shock is currency. When global uncertainty rises, investors panic. And when investors panic, they run toward one place, the US dollar. Money flows out of emerging markets like India and into safer assets like US Treasury bonds. That means the Indian rupee weakens. And here's the cruel irony. India buys oil in dollars. So when oil becomes expensive and the rupee becomes weaker, India gets hit twice. Let's simplify that. Imagine oil rises from $80 to $130 per barrel. At the same time, the rupee weakens from 83 rupees to 88 rupees per dollar. India isn't just paying more for oil, it's paying much more in rupee terms. This creates pressure on India's current account deficit, basically the gap between what India imports and exports. And historically, large oil shocks have caused serious problems for India's economy. In 1991, an oil shock combined with other factors triggered India's famous balance of payments crisis. The country had barely enough foreign exchange to cover 2 weeks of imports. India had to literally pledge its gold reserves to avoid default. Now, today's India is far stronger. Foreign exchange reserves are huge. The economy is bigger, but oil shocks still hurt. A lot. Then comes the third ripple effect, government finances. When oil prices spike, governments face a nasty dilemma. Either allow fuel prices to rise sharply or reduce fuel taxes to soften the blow. India relies heavily on fuel taxes. They are a massive source of government revenue. If taxes are cut to control inflation, government income drops. If taxes stay high, public anger rises because fuel becomes expensive. Either way, fiscal pressure increases. And when fiscal pressure rises, government borrowing rises, which pushes up interest rates, which slows economic growth. all triggered by a conflict thousands of kilometers away. But the story doesn't stop with oil and inflation. There's also trade disruption. The Middle East isn't just an energy supplier for India, it's also a major trading partner. The region buys Indian goods and hosts over 8 million Indian workers. These workers send billions of dollars back to India every year as remittances. If war destabilizes Gulf economies, those remittances could slow, and that money is crucial for millions of Indian households. It supports families, education, healthcare, and consumption across India. So when Gulf economies shake, parts of India feel the tremor. And then there's shipping. If war spreads across the Gulf, shipping costs explode. Because cargo ships suddenly face missile threats, naval patrols, and higher insurance premiums. Even if ships still sail, they become far more expensive to operate. Those costs eventually get passed on to consumers, which again means higher prices in India. But here's where the story gets complicated, because not every effect is negative. In fact, some sectors in India could actually benefit from global instability. For example, India's refining sector. If Western countries reduce Iranian oil exports again, global supply chains rearrange. Indian refineries have historically taken advantage of discounted crude from sanctioned countries. Another potential winner could be defense manufacturing. War increases global demand for weapons, surveillance systems, and military equipment. India is pushing to become a defense exporter. Conflict zones often accelerate that demand. But these gains are small compared to the massive macroeconomic risk created by oil shocks. Because energy sits at the center of everything: transport, manufacturing, food supply, electricity. When oil prices surge, the entire economy feels it. And this is where the narrative gets slightly absurd, because modern economies are incredibly complex, yet fragile. A drone strike near a refinery in the Gulf can raise vegetable prices in Delhi. A missile fired in the Strait of Hormuz can weaken the Indian rupee. A naval blockade near Iran can affect the interest rate on an Indian home loan. Globalization has connected everything, which means conflicts travel through financial systems at the speed of markets. And this is exactly why India has been quietly trying to reduce its vulnerability. Strategic oil reserves, diversifying suppliers, buying oil from Russia, investing in renewable energy, electric vehicles, solar power, green hydrogen. All of these moves have one hidden objective: reduce dependence on volatile oil regions. But the transition is slow. India still runs on oil, and for now, the Persian Gulf remains one of the most important energy arteries feeding the Indian economy. So, if a real US-Iran war breaks out, India won't be fighting on the battlefield, but it will still be negotiating the consequences through oil markets, through currency markets, through inflation numbers, through fiscal pressure. The battlefield may be in the Middle East, but the economic aftershocks will ripple through New Delhi, Mumbai, and every fuel pump in the country. And that leads to the bigger question nobody really knows the answer to yet. If the next global conflict disrupts the world's energy system, will India's economic growth machine keep running? Or will the price of oil once again remind the world just how fragile modern economies really are? I will see you in the next one.